As we've discussed, it's essential to establish a scientifically sound and well-regulated system for healthy development. This applies to all parties in our market, including regulators, policymakers such as the China Securities Regulatory Commission, and market participants. All the market regulators and participants should be jointly involved in building the market. Now incidents like this are actually abnormal, but why does everyone remain silent? It's because there are clearly problematic policies. So why are such issues so prevalent in China? What we hope is for regulators to step back and focus on governance. We've already implemented the registration-based IPO reform, and the fundamental purpose of this reform is to allow as many qualified companies as possible to go public. Everyone should access and utilize the capital market fairly. But now, it has become unfair. Some industries are allowed, while others are not. When you make these differentiated decisions on behalf of the market, you are essentially making selective choices. You believe certain industries deserve special support. However, this should not come at the expense of other industries' rights to access the capital market. If you give special responsibility to certain companies over others, that does not create a fair environment. If we can't even achieve a level playing field for competition, how can this market be healthy, regulated, and effective? How can we expect all market participants and entities to develop confidence in fair competition? Thirdly, we can't attribute everything to Chinese characteristics. Overemphasizing these so-called Chinese characteristics has led to our market, including the regulatory authorities, exerting influence within the market or introducing various measures. This increases the likelihood of policies that are unreasonable or unscientific, because they are said to have Chinese characteristics. In reality, this is window dressing, or the securities regulator deciding behind closed doors. It's like creating a new vehicle to support technology innovation enterprises. A policy is introduced, but this policy doesn't listen to market opinions or respect the logic of fair use of the capital market. I think a balanced approach to incentives is more scientific. We need to support the STAR, Science and Technology Innovation Board, market, but also develop sectors related to people's livelihoods and consumer services. Even if you give 3 opportunities to the STAR, Science and Technology Innovation Board, market, you should at least give 1 to consumer enterprises. That would also be reasonable. How can you implement a one-size-fits-all approach and just reject everyone? The reason given is that resources are limited. The reason is that the capital market isn't doing too well. The reason is that we need to support technological advancement and solve our bottleneck issues. All of these arguments sound perfectly fine. So this ties back to what I mentioned earlier, and your question is a very good one. Because on the surface, these choices seem very positive and proactive, but what do they actually bring? They lead to some negative feedback and create certain policy obstacles. We're discussing formal synthetic barriers. These suppress things, sacrificing others' interests. This creates other forms of, this is unfair, these are artificially created injustices. And I believe that a more scientific approach is to provide support for scientific and technological innovation enterprises, technological progress, and the capital market. We must support companies that are solving critical technological bottlenecks, and we need to give support. That doesn't mean we shouldn't develop consumption, or improve people's livelihoods, or that we don't need our own KFC, Starbucks. We still need all of these things. Regarding technology investment, our policies are quite relaxed. For instance, listing standards are relatively low. For our Hong Kong Science and Technology Innovation Board, including life sciences and hard technology, the listing requirements we set are comparatively lower. Of course, I also understand. In the process of supporting tech enterprises, we need to take some unconventional measures, and these measures will inevitably attract some speculative capital seeking arbitrage. Consider the 4 AI dragons in the chip industry. Everyone knows their current situation. A few years ago, they were all the rage, rushing to go public. The end result? No one made money, no one was profitable, their main sales were government deals. Mainly, they sell to the government. Basically, they can't sell elsewhere. In the consumer market, they haven't become a major product, they haven't truly entered the market for survival. They haven't gone through the test of surviving in the market, nor been truly validated by it. They survive by relying on quick wins or landing big BN clients. From the fate of the 4 AI dragons, you can infer the situation of many other companies. These things are both universal and have their own particularities. Tech companies have a unique characteristic. A great one can emerge, justifying investment. This is due to the tech industry's winner-takes-all, exponential growth effect. Consequently, much capital enters the tech sector seeking arbitrage or relaxed opportunities. The environment for IPOs and finance is accommodating, with high risk tolerance for delisting. They receive preferential treatment and favorable conditions. Incentives create arbitrage opportunities. No 3-year profitability, large scale, or specific profit level is required for IPO. This market's acceptance fuels speculation in tech innovation, technology, and hard tech. This trend, however, brings up an issue. What's the problem? It means our capital market faces greater pressure, because the higher you drive up speculation, the harder you'll fall. Everyone knows, at its core, this is still a speculative activity. If a company's intrinsic value doesn't match its market positioning, it will inevitably collapse. So if you look at our AI sector, or look at those companies, on the Shanghai STAR, Science and Technology Innovation Board, market, I would say, with almost no exceptions, most of them have reverted to their original state, and it looks pretty bad. What's the second phenomenon? Many people who enter the market, buying courses, or collecting deeply, end up losing money. What happens? Many companies start speculating on STAR, Science and Technology Innovation Board, market companies with a high shell value, like chip companies. All these companies are losing money, not just retail investors, but even professional investment institutions. Those who got in during later rounds, or investors with issues, all lose money. So when there's no wealth effect, what happens? In the opposite scenario, it turns into a sickle effect. The market becomes like a field of leeks, and the sickle quickly reaps its profits in dividends. This negatively impacts the STAR, Science and Technology Innovation Board, market's development, tech companies' progress, technological advancement, and innovation. The original intention behind the STAR, Science and Technology Innovation Board, market's positioning will actually end up bringing negative effects.